It was another dramatic day on Wall Street, but today the drama was to the upside. In fact, we saw one of the largest increases in the history of the stock market. For the Dow Jones Industrial Average, we were up 11%, which was actually the best day since 1933. So you'd have to go all the way back to the Great Depression to see a day like we experienced today on the Dow. Even the S&P 500 was up 9%, which was its best day since the 2008-2009 financial crisis. So really dramatic trading here today, sharp bounce back rally. Now a lot of people are wondering, is this the bottom? Is this possibly the moment that we've all been waiting for? And I think the general consensus thus far is we're still in a wait and see mode. It was nice to see a little bit of an exhale in the market today. It's been some time coming, but there's still a lot of work to be done. There is a nice stimulus package that's coming through. Larry Kudlow was touting the bond buying opportunities of the Fed, and we're hoping to see something from the Senate to support the American people as well shortly. So that can certainly help support the markets. But then, of course, we still have negative news stories that we're grappling with. For instance, the Olympics just today was announced that they're going to be postponing that for a year. So a very interesting time in the markets that we find ourselves in right now. But at least we had a nice relief rally here today to work off of. So we'll talk about all of that. Then we'll get into our trade application example, where I want to review a company that has been in a downtrend for the last 3 months, has risen sharply in the last week or two, and appears to be at a little bit of a point where it's running out of gas, and maybe it would be an opportunity to do a bearish trade on it. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 24th, 2020. For those of you that are brand new, welcome aboard. Remember to go over to our YouTube channel and click subscribe while you're over there. Make sure you sign up for our email distribution list as well, and that way you can be notified of the posting of these videos and also get a heads up on what stocks are giving you overbought and oversold cluster signals in the S&P 500. In addition to that, we're heavy users of Twitter, and we would encourage you to follow us there. My handle is @BrandonVanZ, and we appreciate those of you that click like and retweet on these Market Outlook related tweets to help encourage us to do them as often as possible. And then lastly, we have a presence on Facebook as well, and we'd encourage you to join our group there. All right, so let's go ahead and jump into our charts. As you can see, I've got chart 6D pulled up here in front of us. This is showing us some very dramatic price action. Now, up until about a month ago, I rarely showed this particular chart. I generally reserve it for a day when we have what used to be a volatile day, when we'd have a 1% move up or down. 1% moves are almost an afterthought in the environment that we find ourselves in right now. In fact, I saw a tweet earlier today that says that on a 20-day look-back basis, this is effectively the most volatile the stock market has ever been, even surpassing some of those moments in the Great Depression. So anyway, this is rarefied territory that we find ourselves in right now. But of course, as I mentioned before, the drama today was to the upside. Look at the towering green bar that we find on this particular graph here. When we built this out, our final horizontal line was at the 3% level. Today was 3 times what we had considered to be extreme when we were building this out was. This was a 9% up move for the S&P 500 today. You can see what that means from a candle perspective here as well. We did get what's known as a hold, or a close above the high of the low day. But before we get too excited about that, we have to remember we had a hold right here and a hold right here as well. And those ultimately left to with failed attempts there, and the bears did take control. So I wouldn't put too much emphasis on the hold when we find ourselves in a dramatic downward spiral like we have been for the last several weeks as a result of this black swan that kind of came out of nowhere and roiled the markets, known as the coronavirus. And without a resolution to that from a health perspective, it's going to be a hard time for the economy and the stock market itself to kind of get its feet beneath it as well. But I did want to show you that it had been a long time since we saw a day like today. Again, this is a 9.38% day for the S&P 500. If I come on up here and look at a different time period, I'm going to click on 15 years, and we're going to keep that aggregation period as a day. Then I'm going to click OK. This will make the lines look really thin, but I'll zoom in just a moment. I just want to kind of show you again where I'm circling my mouse right there is where 9.3 is on our graph. But as I start scrolling over, you'll notice that the last time we had a day like we experienced today in the S&P 500 was right back here. This was in October of 2008. We actually had 2 different days like that. So if I were to kind of zoom in on that time period right there, we'll be able to see those bars a little bit better. And on this particular bar, we were actually up about 11% there on it would have been October 13th of 2008. And then we had this follow-up day here that was nearly as impressive on October 28th of 2008. And that was where we were up about 10.7% or 10.8%. So those 2 days were a little bit more impressive than what we experienced today on the S&P 500. Now remember, the Dow is a little different. We had a stock like Boeing that was up 20% today. Remember that the Dow Jones Industrial Average is a price-weighted index. And so when you have higher price stocks like Boeing, they have a bigger impact on the movement of the underlying index, the Dow Jones in this case. So the Dow Jones actually did have a day today that was bigger than all of its days that it had during the 2008-2009 crisis. You'd have to go all the way back to 1933, as I mentioned in the intro, to find the last time that we saw the Dow Jones go up 11% as it did today. But nonetheless, the S&P 500 up 9% was a very, very aggressive day. Now, the other thing I wanted to point out, since we're kind of talking about this era back in 2008 and 2009, since, unquestionably, you guys are probably wondering, is this the low? Did we experience the low yesterday? And I'm still a bit cautious around that. I tend to think that the market may have inflicted enough price pain on us, but it doesn't really feel like we've inflicted enough time pain on us. This has been a very sharp move lower in just a month. And a lot of times you look back through history where we've gone into a bear market where the stock market's down over 20% for an extended period of time, you typically find that you don't have a V-shaped recovery and you're just done with it like that. Now, is it possible? Yes, every 20% pullback is different than the previous one, and this one is certainly unique where we're dealing with a health concern that is basically shutting the entire economy down. And when we're dealing with publicly traded companies, as we do in the stock market, they are not built to have no customers and to be forced to shut down their operations by the government. They're not built like a nonprofit charity type of a situation. The whole purpose of the stock market is to seek profits, and so there are definitely a lot of industries, a lot of companies that are going to have challenges and problems for quite some time, even if we can get this coronavirus solved. It's just going to take a while to get the psychology of the consumer back to where it was previously. But even when we were dealing with more of a financial crisis as opposed to a health crisis back in 2008 and 2009, yes, we had a very aggressive 11% day right there, and we had a very aggressive 10% day right there. And one thing that you'll note, I know it's kind of hard to see because it's a little bit distorted here. Maybe I can bring this up a little bit. It doesn't help a whole lot. But anyway, that's the candle right there. And that's the candle right there. Now, what you should be looking at is the fact that that was not the bottom, right? We were at about, let's call it 800 or 900 on the S&P 500 around those 2 occasions. We eventually went all the way down to 666. So these big snapback rally days occurred in the early part of that really ugly era of 2008 and 2009. Those were times right after Lehman Brothers had gone down, and the folks in DC were pushing through government stimulus packages and different things like that. But it really wasn't actually the bottom in the stock market, even though that was when some of the most dramatic stimulus action was taking place. Eventually, the stock market did bottom, but it took another 4 or 5 months after that. Is that going to be, a repeat for us here this time around? anybody's guess, but at least we have a guide here to go off of. Now, on the flip side, remember, it's important to keep an open mind when we're going through this. There is no rule book when it comes to the stock market. If we do get some sort of a resolution to this coronavirus and we start getting some vaccines developed and people feel more comfortable, could we rise out of this a little bit more quickly? It's possible that we could, yes. As I mentioned before, they're talking about a $6 trillion package. Larry Kudlow was here today. That's the biggest stimulus package the feds have ever initiated. So somebody on Twitter today said that $6 trillion, even in inflation-adjusted terms, is greater than the total amount of money spent during the war effort of World War II. So this is a tremendous amount of money they are pushing onto the system. That could certainly have the possibility of lighting a fire, and we might even see a little bit of inflation. I know gold was up a bit here today. And the other positive part of the story, I would say, is from all intents and purposes, it looks like China is on the road to recovery already. Remember, they really were struggling with this coronavirus back in January. And here we are 2 months later. China is actually seeing a fairly strong stock market. It's one of the stronger markets in the world, and much of their society is getting back on track to the way things were before the virus hit them. So, if you kind of take that trajectory, it's possible that here in the United States, maybe by the end of April, beginning of May, we might be kind of taking a collective sigh of relief. Then again, we have to remember that China clamped down on it pretty hard. They completely shut down several multi-million population cities right out of the gate, whereas we were a little bit slow to react here in the United States, at least to that grand measure. We are starting to see a little bit more of that now with New York and some places in California that are doing it. But it remains to be seen whether that was a little bit too late and whether we're going to have to kind of carry that burden a little bit longer than China was forced to as a result of some of their measures. And there's a lot of bad news coming out of Europe as well, with Italy and Spain really getting hit. So this is not fun for anybody. And the capital markets are recognizing that it's not just a human tragedy, it's an economic tragedy as well, because when humans are locked up in their houses, they're probably not going to be spending nearly as much money as they were once upon a time, and therefore that's going to be negatively reflected in the stock market, for better or for worse. So anyway, interesting times that we find ourselves in here right now. I did also want to show you here on the, let's go over to the Market Watch tab. This was a very, very one-sided market here today, as most of you would imagine. When we have kind of record-setting days to the upside, there were only 11 stocks in the S&P 500 that were down today. And from what I could tell, this was kind of like an exact flip-flop type of a day, where you had the worst performing stocks doing the best, and you had the stocks that had been doing quite well doing poorly. So, stocks like Kroger and Clorox that were doing quite well compared to all other stocks up until today during this whole coronavirus scare, they actually were down today. And you saw some others like Regeneron that had been benefiting recently, they were down. So, it was really the coronavirus plays that had been doing well that did poorly today, and then most of them that had been demolished before did really well. In fact, one thing I could show you over here, I don't talk about this a whole lot here in these videos, but remember, those of you that follow me on Twitter know that I do this 9 at 9 every morning of every trading day, basically looking at the 9 strongest movers and the 9 strongest losers, so the biggest winners and the biggest losers at 9 a.m. Eastern time, to get a sense of what stocks are likely to move the market that day. So these numbers will have been adjusted, many of them upwards as the day started. But even before the stock market was open, we saw the flavor of the day starting to emerge. So here on the 9 at 9, you saw Norwegian Cruises, Royal Caribbean, Delta, United Airlines, Carnival Cruises, Boeing, American Airlines, MGM Resorts. Those are all travel-related plays, and they were right out of the gate, even in the pre-market session, up double-digit percentages. And most of those companies had been ones that had been absolutely clobbered. In fact, you'll notice here that these little red bars that are associated with it mean that those stocks are down more than 10% in the last 3 weeks. So every one of the biggest movers out of the gate today were stocks that had absolutely been trampled in recent weeks. So we'll see if it's more than a dead cat bounce or not. Obviously the president has said that they plan to support the airline and the cruise industry and travel industry. So what that means going forward in terms of government packages remains to be seen, because we haven't seen any details around that other than just this general philosophy of we're going to support you. But at least they were able to have a nice little snapback there today. Also, while I'm over here, real quick, wanted to show you what's been happening from a sector perspective. This is the sector selector that I put together on Friday evenings for my Monday top-down trend trading class, where we use it to kind of decide what types of trades we're going to be taking in that class. Anyway, one thing to report there is that the consumer staples are the new top spot on the sector selector. So those stocks that have been attracting investors as a result of rumors of hoarding that's going on out there, whether it's Kroger or Clorox or toilet paper companies like Kimberly-Clark and Procter & Gamble. There's a number of those companies that have been benefiting. Even Walmart has actually kind of breezed through this whole crisis a lot better than most mega cap companies out there. So consumer staples seem to be one area that's maintaining some value. And then technology was kind of removed from the top slot there, but they still have some interesting stocks within the technology area that are kind of stay-at-home plays with digital technology that tend to benefit from that. And then, of course, healthcare is right in the mix as well, with companies like Regeneron and Gilead Sciences and Moderna and a few of those types of companies that are kind of vying for some sort of a cure to this coronavirus. So anyway, not surprising to see energy continues to be dead last, and financials are second to last on the rankings this week. Also, while I'm over here real quick, thank you to those of you that are clicking like and retweet on our market outlook related posts. Let me go ahead and click on that. For some reason, I'm getting a little bit of delay here. I've got a lot of different programs going. You can see that over 100 of you clicked like the last time I did the video, and we always appreciate that. Anytime we can get into the triple digits, it's our way to find out from you that you want us to do these videos. So if you want to help support these daily videos, we have one single ask of you, and that is just simply click like. And if you do that, it's your way to tell us to continue to do those videos, and it's a way for us to kind of spread the knowledge about these videos to other folks as well. Speaking of the videos, some of you might notice that I'm not using the video camera here tonight. Those of you that are premium members would have received my email over the weekend regarding some personal schedule changes as a result of the schools closed down around here. So my wife and I are kind of scrambling to figure out how we can take care of our kid and then also do our day jobs. Both of us still work in the financial industry, and so we're still doing whatever we were doing in the past in addition to teaching preschool. And so in order to get these videos done sooner than I would otherwise, I need to not use the video camera there. So again, see my email over the weekend for those of you that are premium members, because it does have an adjustment to my premium schedule as well. Tomorrow, my factor-based swing trading class will be at 10 a.m. Eastern Time. It used to be at 11 a.m. Eastern Time, but for now until probably May, I'm going to hold all of my classes at 10 a.m. Eastern Time. I need to get that done earlier so that way my wife can get to work after I'm done. So we appreciate your patience with that, as a lot of us are being personally affected by this whole coronavirus thing here. I know many of you are as well. So all 5 of the trading days from now until at least May, I will be doing the 10 a.m. Eastern Time slot. And tomorrow happens to be my factor-based swing trading class. And remember, that's a class where we can do some short selling and other bearish techniques if you're interested in that. And then David will be teaching his options inventory class after that. All right, let's go ahead and take a look at some charts now, kind of see what's shaking over here on the Thinkorswim platform, starting with chart 4B. And one thing that you might be surprised to learn is that despite the, in some cases, record-setting days that we experienced today, remember for the Dow Jones up 2,100 points, that's the biggest point move in history, although it's not the biggest percentage move. Nonetheless, this is rarefied air that we find ourselves in terms of the big moves that we saw today. Some of you might be surprised to learn that despite these massive historical rises that we experienced today, we still have a bearish posture. A lot of times you would think that if you had a dramatic move of 9% or 11%, those are numbers that sometimes you get and you're happy for an entire year, let alone one single trading day. You probably make the assumption that that must come with a bull market. And that's just simply not the case yet. You can see that the background colors of our charts remain that darker shade of pink, letting us know that we still have strongly bearish postures despite this massive dead cat bounce that we got here today. We'll see how long that lasts. I would say that it looks like to me the NASDAQ is the one that has the greatest chance of emerging with a bullish posture first. We'll see if that happens or not, but you can see that it's the only one that has its intermediate line in the double digits right now. It's at 12.43 and rising. And remember, the way that the market forecast indicator works, for those of you that might be newer to this video, the market forecast technical indicator can be found on the Thinkorswim platform from TD Ameritrade. But the way that it works in terms of the upper reversal zone and the lower reversal zone is that the lower reversal zone is at 20. So right now at 12.43 and rising, we're still in the lower reversal zone, meaning that the bears are still in control of this market. But if this continues to rise and it emerges above 20, we would then start moving our posture to weekly bullish at that time. So since the NASDAQ is at 12, whereas the S&P 500 and the Dow Jones and the Russell 2000 are all still below 10, it appears that the NASDAQ has a little bit of a head start there. It's been maintaining some semblance of of strength here in this move more recently. So anyway, we'll see if that happens or not. But right now, some of you might be surprised to learn that we still, at this point, have bearish postures. In fact, I could take it a step further and point out a fairly rare signal that we don't get a chance to talk about a whole lot, which is a bearish intermediate confirmation signal. Those of you that have watched these videos of David and I's over the years, you will probably recognize the bullish intermediate confirmation signals. Those are fairly regular during a bull market, but it's been fairly rare to find the bearish intermediate confirmation signals. And you basically just flip the bullish intermediate confirmation signal upside down to do the bearish one. And in order to do that, what you're looking for is the green line in a bearish posture. So remember, you can have the green line be bearish by having the green line falling between 80 and 20, kind of like the NASDAQ was over here in February. So that would be one way to get the green line with a bearish posture, or just simply have the green line in the lower reversal zone below 20. And of course, that is what is represented by all four of our charts right now. All of them have the green line below 20. So we have a strongly bearish posture from an intermediate perspective right now. So the bearish intermediate confirmation signal is then when you match that up with the red line, in this case it's the momentum line, in the upper reversal zone. So it has to be in the upper reversal zone, and you can see that is the case on all four of our charts right now. Not only that, but you'll also notice that the blue line is between 80 and 50. So remember, the blue line is not technically part of those confirmation signals, but similar to how we talk to you guys about on the bullish intermediate confirmation signal, we want the blue line to be between 50 and 20 to have enough of an exhale. It's kind of the reverse mindset when you're doing the bearish ones. You want that blue line to be somewhere between 80 and 50. So this is a more ideal setup, is the way that you could think about that. So that is of interest to many of you as well. It's kind of the idea. So remember that the bullish intermediate confirmation signal is a buy the dips mentality. So if you flip that mindset around, then a bearish intermediate confirmation signal like we have on all four of our charts here today is a sell the rips mindset. And And remember, that's exactly what I was talking to you guys about a week ago as well. Last Tuesday, we also happened to have a pretty strong bounce in the market. And I was mentioning at that time, this is a market where you tend to sell the rips. And lo and behold, we ended up having yet another lower low between now and last Tuesday. Will that happen again this time? Is anybody's guess, but at least the signal of the bearish intermediate confirmation signal does exist, and therefore maybe gives you a little bit more confidence to put on a bearish trade here, even though some people might really be kind of waffling, trying to decide what they should be doing. Sometimes you need to lean upon your technical analysis to give you a little bit of boost in one direction or another, understanding that, of course, technical analysis will never be perfect, but at least if you're consistently following your rules and applying them the way that they're supposed to be implemented, that hopefully you'll find some better success when you are consistent. So anyway, we continue to have bearish postures across the board in the stock market. In fact, we have bearish intermediate confirmation signals across the board as well. Let's go ahead and do some 12 grid analysis now. Let's start with 5A, and this is our asset class 12 grid. And as you can see here, there's a mix of pink and green charts. I did want to point out gold. I kind of mentioned that before, but I talked about gold last week and how it had been disappointing to me. I had thought that maybe gold would hold up a little bit better than it had in this type of a market, and it really was a bit disappointing. Well, maybe it's just taking a little bit of time to warm up to the idea of what this market represents. We do have gold all of a sudden above a rising moving average again. The background color is light green, telling us that we have a weekly bullish posture. Notice that the green line is at 32 and rising, so it wouldn't turn into a strongly bullish posture until it got above 50. But at least we're kind of back in that trend that we were in before that. Right? Gold did rise with the market today, but you look at S&P 500, it's not up here back in the trend that it was prior to the coronavirus news, whereas you could maybe make that claim with gold. Gold did fall in the last couple of weeks, but it's bounced back equally as sharply, and I do wonder if what I was mentioning before about Larry Kudlow and the expected $6 trillion worth of stimulus, that's an awful lot of stimulus there. If maybe there are some inflation expectations that are starting to come into the market, and gold is getting a little bit of a boost there. So keep your eye on that. There's some opportunity in the gold market, particularly with GLD. That tends to be your most liquid opportunity from the market perspective. Remember, a lot of those gold mining companies are really tiny in market cap. And so you don't really have a whole lot of liquid opportunities there. So if you are looking for like options trades, oftentimes just doing it through GLD is a better choice there. Anyway, some of the other areas that have green are still TLT, which is the long-term government bonds. Foreign bonds also have a green background, although their chart doesn't look nearly as good as U.S. government bonds. And then preferred stocks got their green chart back as well. But again, similar to foreign bonds, this is still a stock chart that I'd be a little bit hesitant around. So, right now, when you're looking at what are the best looking trends, what you could say is there are two charts on the board, TLT and gold, that both have a green background color, and they both currently have a green moving average, telling us that price is above a rising 30-day moving average. The other ones are a little bit more of a crapshoot. In terms of the negative trends out there, there's a lot of them. You don't have to look too hard, because all of these are just falling off of a cliff, whether it's the U.S. markets, the foreign stock markets, the high-yield bond market that's really been crushed because of oil prices, that in oil directly below you can see has really struggled here in the last couple of months. REITs, some of you that follow me on Twitter have been kind of reading some of my commentary about my expectations around future dividend cuts, and it is my belief that we're going to see a lot of dividend cuts out of the REITs in the coming year as a result of their requirement to pay out 90% of their net income. And I just think a lot of them are going to see their net income dry up as a result of the coronavirus here. So we'll see. Only time will tell on that. But real estate's really been crushed here recently. And there's talk about the government telling people that they don't have to pay their rent this month and different things like that. And that brings up the question, well, and if they're not paying, then who is? Are the real estate companies going to be left on the hook, or is the government going to somehow pay for that? So there's a lot of questions out there right now, but the value of the buildings and the real estate itself can probably be maintained. My hesitation is more so around the cash flow from the rental checks themselves, and the dividends that ultimately come from that, I think, are going to be in question in many cases. And then also, interest rates have been in a steady decline here for much of the last 3 months as well. We find ourselves at about 0.81% on the U.S. 10-year Treasury yield right now. In terms of sectors now, let's go ahead and take a look at the U.S. sectors, 5C. And here you can see it's a bloodbath. Despite today's massive rally across the board, you had some really eye-popping numbers here today. Of course, the ones that were hit the hardest to the downside were the ones that typically snap back the biggest here today as well. We had XLE that was covering the energy stocks that was up 16% today, yet remain 55% lower than where they were 3 months ago. Isn't that crazy to think about? An entire sector that was up 16% in a day, but is still down 55%. They were cut in half in the last 3 months. And while the other charts aren't nearly as bad as energy, they are still some of the ugliest 3-month time periods you'll ever see when it comes to entire sectors. We're talking about the financials down 35% in 3 months, despite rising 12% here today. Real estate down 27% in 3 months, despite rising 9% here today. Utilities, which was actually the sector that we covered in my dividend growth investing class today. In fact, we were able to look at a utility stock that has a long history of raising dividends for the very first time in probably about 4 or 5 years in my dividend classes today as a result of the carnage that's been taking place. So for those of you that are interested in what dividend opportunities are starting to emerge from this rubble that we've seen from the coronavirus, I would encourage you to attend my Tuesday dividend growth investing class. Remember, that's available for both plus and premium members of Market Scholars. We had a great conversation today about a couple of elite utility companies that are now, for the first time in years, in attractive zones to be purchasing for the long term. All right, let's go ahead and now get into our trade application example here for today. And I'm just going to pull up chart. How about we do just 4A, just the normal market forecast 1 grid. And I want to pull up a company that many of you probably are familiar with because you use its devices or services. This is Roku. Roku, as you can see, has been in a downtrend for the last 3 months. Now, has that downtrend kind of picked up steam in the last month while this whole coronavirus scare has taken place? Yes, it has definitely been a little bit more violent during this move here. But I find it somewhat interesting that Roku was already in a downtrend. Remember, not all stocks look this way. The stock market was doing reasonably well up until the end of February, yet you can see here Roku, since the beginning of the year, had really been forming a series of lower highs and lower lows, with kind of the exception of that one pop it had after its earnings announcement right there. But otherwise, it had been in a downtrend. This had been a stock that people were already selling. You can see that things really fell apart here kind of at the beginning of March as this stock fell from about 110 eventually down here to 58. So it went down by almost 50% here in like a month's worth of time. It has now snapped back pretty violently. It's gone from $58 and it actually touched $100 here today. Many of you know that $100 is a nice round number that can oftentimes be used as either resistance or support. It's more of a psychological element, but nonetheless, we have seen that play out a number of times. You typically want to think about that in more of a coincidental type of a mindset where there are other supporting elements of what you're trying to accomplish. Now, with this one, what caught my eye is it did not close at the high of the session. Remember, most other companies out there, like Boeing, it closed at the high of the session. It was one of our leaders here in the market today. You look at stocks like, I don't know, maybe MasterCard. MasterCard closed at the high of its session here today. So I found it a little bit suspicious that Roku did not do that. In fact, while 8% is typically considered a very aggressive up day, compared to the 20% move in Boeing and some of these other types of securities, maybe that was a little bit of a letdown. Now, again, you have to take it for what it's worth. This stock had already been rallying violently for the last week, and that was not the case with Boeing and others. So there is that part of the conversation as well. But I just kind of wonder, is this marking an indecision point, this kind of, doji-looking candle here? Some of you might kind of look at that like a spinning top, but a lot of times you're viewing that as an indecision day. The problem is a lot of times you don't know whether that was a reversal pattern until the next day or not. You need the next day for confirmation, but of course I do these videos after hours, so I don't know what's going to happen tomorrow. All I do know is that this stock has reversed and retraced about 50% of the move. If you were to look at kind of a Fibonacci level, this was kind of an aggressive candle back here. So if you're using closing prices rather than the bottoms of candles, the biggest move here wouldn't have been up at the top of this candle. The highest close would have probably been this candle right here. And you come down here to, again, closing prices. This was the lowest close right here. Now, if you look at that, you'll see that right where we touched here today, at the top of the today was right at the 50% retracement level. So, there might be some folks out there that are going to think about, taking some profits or perhaps looking at a bearish trade as a result of that. You will see that we have a green background color. So that is one thing that is kind of flying in the face of this trade. Remember, no trade is going to be perfect, but you did have the green line emerge out of that lower reversal zone today. So technically you do have a bullish market forecast posture on it. However, I would remind you of something that I actually saw David chatting about today on Twitter. When you have these dark pink background colors, a lot of times the light green that eventually occurs, because remember, no stock goes straight down, so there will always be a light green after a dark pink. A lot of times they're very fleeting in nature, and you can even see that here on this chart. If you went back over the last 3 months of this chart and you looked at these dark pink shaded colors and then looked at the light green that emerged after that, notice it went up to that moving average, used it as resistance, and then fell back in that downward channel. Came back on over here, dark pink again, went to light green, again using that moving average as resistance, falling back into that downward move. And then here it was just one day where you had that light green and then immediately went back to that dark pink. Here you had a little bit more time that was spent in the green there, but that was partially as a result of the earnings that people were speculating along on those times. So I'm beginning to wonder if where we find ourselves right now on Roku is somewhat similar to like this over here as it approached the moving average, or even right here and right here. In other words, I'm wondering if we're getting close to kind of an exhausted move here for Roku in the short term, where we're going to have more of an opportunity for a reversal back lower and kind of spend more time in the penalty box with this one, continuing that downward trend that's been set in place for the last 3 months. Now, again, this is kind of considered one of those, so-called stay-at-home stocks. So it's possible that those types of companies could start, picking up steam to the upside. So we always want to be mindful of our position sizing, and we don't want to get too aggressive with what we're doing. What I thought we would do here today in this case is sell a call spread, a bear call spread. In other words, we're going to take in a credit to kind of make a bet with the market that we are near the end of its upward move and it will soon fall back into the channel of a lower move. And if that does not occur, the benefit of doing a bear call spread is that we have defined risk. We know what our worst case scenario is. So if all of a sudden all of these stay-at-home stocks start erupting higher and we are miscalculating this chart right now, at least we will know what is our worst case scenario. Whereas if you're just shorting the stock outright and then the stock gaps up $50 on a day for some odd reason, you're really in some trouble in that type of a situation. So the nice thing about options trading is you can kind of control your risk a little bit more so than you would if you're just doing a short selling situation with a stock outright. So let's come on over here. I've got the contracts pulled up down below already. So what I'm using is the April monthly contracts. We will not have an earnings announcement between now and then. So this will be based purely on the technicals. You will see that I've chosen the 110 strike call to sell. That's my sold strike, so -1 contract there, and then +1, so my bought strike is going to be the 115. These two, of course, in the month of April combined are what's known as a vertical spread. You will notice here that I'm going to get about a credit of $1.14. That's interesting because that was actually a higher number when I looked at it before doing this video, so I don't know why that changed all of a sudden. Let me just check. I want to see if we're still going to get approximately 30% return on risk, because we were previously, but let me just verify now that the numbers have changed. So 114 divided by 386, I'm getting those numbers right there, gives us a return on risk of 29.5. So yeah, if you round it up, you would be right there. The other thing I should mention is that the futures are up right now. Now, whether that holds into tomorrow morning's open is anybody's guess, but the futures have continued to rally after the stock market closed here this afternoon. So remember, if this stock were to go up and start tomorrow off a little bit higher, it's possible we'd get filled at a better price as well. Anyway, we'll go ahead and send this off. And remember, what we're hoping to accomplish is have this stock stay below 111.14. So let me send that off. And then when I come over here to the charts, I'll show you where 111.14 is. And it's about right there. So in other words, the downtrending 30-day moving average could also be our last line of defense in a bearish trade like this. In other words, if you expect this stock to continue to go up a couple more bucks, but it tops out at the moving average like it did right there, like it did right there, like it did right there, or like it did right there, then our trade should be in good shape there. Now, if it erupts above that moving average on the wrong day, right around the option's expiration, it's possible we get pinched by that as well. But at least we have some historical precedents to suggest that this stock that had been in a downtrend and had shown weakness around that falling 30-day moving average is now setting up for another one of those types of opportunities here today. Okay, so with that, I want to wish you all the best of success with your trades and your investments. Remember that David will be back with you tomorrow. And for those of you that catch his live trade management portion, remember that's available to those of you that are both Plus and Premium members. I'm sure he'll be doing that as well as he typically does there on Wednesdays. And I'll look forward to seeing many of you Premium members in my swing trading class tomorrow morning. Have a great night, everybody, and we'll see you all later. Bye-bye.